side.
All right, we're live on both sides. Hello, everybody on Endowus, everybody on 1865. Good to see you. Everybody who come in, remember, just say hello to Sam and myself so that we know that you're there. At least I know that the system is working. And also, is the sound working?
Yes.
Is the sound test working?
I think it's okay.
Yeah. The light is a bit dark on my face here.
Is this gonna be turned on? This light, ring light? No.
No?
All right.
Okay.
Okay. Well, I think that we have multiple streams today, right?
Yeah. Okay.
So we have it on Endowus channels, and then we have it on all of your channels.
I think quite a lot of our guys are with your channel.
Endowus channel as well.
Because there's $100 voucher there.
But also for those of you who've never met Lou and
Jackie,
are coming through on the Endowus channel, this is not our typical webinar, so we're not going to run it like it. It's very casual. It's Saturday, so it's not a work day, right?
Yeah.
So we're going to run it very casual, even though I'm dressed here because of another event.
Yeah.
But yeah, so amazing. Great to see you, Lou. Haven't
Great to
seen
see
you
you.
in a while.
We haven't seen each other for a long time.
Yeah,
Man.
we've both been traveling.
I can't see the stats on your side. Okay. Right. Okay.
Yeah.
So everybody, remember, please give a like. Okay. And the reason why I give a like is so that the video will be then promoted, so that more people can see. Mm-hmm. It's very rare, at least for my channel, to be able to invite Sam here. Okay.
And it's very rare for us to have Lou as well at Endowus channels. It's a collab.
Is Sam running for president too? He doesn't qualify.
I don't qualify. We have enough good candidates, and I think we know who.
He doesn't qualify because he's not Singaporean.
Not Singaporean.
Yeah. but the other criteria, I think he will meet, right? You need, because he's ex-CEO of Morgan Stanley, right? Yeah, so I think all the other qualities he will qualify.
I was on a panel with another ex-minister just now, and
Sure.
he was saying how in politics, if you don't have the support of your wife and family, then you're doomed for failure. And I don't have that support either. So my wife's family comes from politics, and she would never, ever, ever, ever want me to.
I think Korean politics is the more complicated and more colorful.
So bad.
All right, good.
Yeah.
Okay.
Anyway.
All right, good. Okay, I think we have got 200 people, more people streaming. Please remember, give a like, and please stream in the questions. Okay. So I'll start off with a few very interesting thing about. So the title of today's talk is 1M50E. Okay, 1M50E.
Can we actually show the slides at this point, because we have to show some disclaimers?
Sure.
Yeah.
Oh yeah. Disclaimer.
Yeah.
I also want to.
Yeah.
I also want to say the disclaimer.
Okay, so we'll start with the Endowus disclaimer, which shows up on the slides very quickly, and then we're going to move to the Slido as well. So if you have any questions for us, you can type here on Lou's channel, or you can use the Slido, which is Endowus PF, and you can ask questions there. And then this is the one that Lou talked about.
So if you go to the Endowus channel, and someone can please pin it,
Upload it on the
YouTube
channel.
for new customers of Endowus, there is a $100 QR code for you to claim when you sign up with Endowus. Okay, I don't know what's the T's and C's, but I suppose that if you sign up and as a new investment, invest in a new investment product, I'm sure there is $100 off for you. I didn't get that. Okay, I didn't get it. How come they get that? I didn't get that. Okay, so never mind. And he still owes me a char siu rice.
He's rich.
He still owes me a char siu rice for 2 over years.
We're doing a session about having 1 million by 50 in your CPF, and you're complaining about fees.
I want the char siu rice.
The char siu rice, I have to deliver. I have to promise.
The char siu rice that he promised was shut down.
Shut down.
That was the best char siu in Singapore.
But now they moved. They moved to a new place, yeah. So that's where we're gonna go.
All right, good.
We're gonna go to the new place, new location.
All right.
Yeah.
So today's talk is on 1M50E. Okay, and I've given 1M65, 1M45, 4M65, but we have been talking about 1M50E. I kid you not, more than half a year ago, almost 1 year ago.
Yep.
Remember, I told Sam that I know my portfolio now is below 1 million. It's going to overtake the 1 million. Both of us are so confident, right? Mm-hmm. And we were already planning for this event more than half a year ago, because we know the portfolio is going to exceed 1 million. Yeah.
Yep.
Yeah. So today we're going to talk about 1M50E, how we do it. Okay. But more importantly is
Few announcements.
no.
No, what?
When I was when I was preparing for this talk, I was doing some marketing platform talking about this. Someone wrote in to me, okay, and if you allow me, I won't quote names, but this gentleman wrote to me, and you know what? I'm going to read to you, and he also did the same thing. Okay, first of all, I'll just show you his screenshot. Okay.
Well, be careful. Just make sure.
Nothing,
Yep,
nothing,
Yep,
right?
nothing.
Okay, I'm going to show you guys, okay? Oh, it's a bit bright, sorry. All right, okay. Now, this is a joint account between he and his wife, okay? CPF, SRS, and a little bit. It is 1 million. And I thought I was quite impressive. I did 1M50E, right?
50.
He's 40 years old.
Wow.
So someone has overtaken me and did 1M40E. Okay, 1M40E.
So what is the E? I don't know. You didn't explain,
E,
right?
you don't know what it stands for? No? Any price? Do you have any price for people?
Messages.
Yeah. 1M40E. What does E
Must be
stand
somebody
for?
who knows, right?
What does E stands for? Okay. Anybody? I don't see any comments here. Are there any comments there?
Comments. Yeah.
Yeah. What do I see? Okay.
No.
Yeah.
Scroll up all the way up. No.
What?
Down.
Yeah, E for Endowus. Yes, not E for
Sound quality
Express.
on YouTube is bad.
That YouTube, not my YouTube,
okay,
right? Okay. So 1M40E, E for Endowus, okay?
Yeah.
Now, regardless whether is it 40 or 50 or whatever the age is, clearly there is a big, huge. This in the past could never happen. Okay, in the past when we have money. I've always preached 1M65, right? 1M65, you just top up into your SA and MA and let it compound, and by 65, your husband and wife, or yourself could. But Sam and his team made one thing possible that has never been done before. I still don't know how you do it because there's no one else could do it. How do you manage to convince the CPF board to allow us to invest in S&P 500, right? You're the only one to do it. I thought like maybe in 6 months' time someone else would do it. Now it's been 3 years already, right?
4 years.
4 years now. Still nobody do it. You have a monopoly, I love monopoly business, by the
And
way.
we have even lower cost ones, so passive low cost index investing at
Right.
the lowest cost, and it's exclusively on Endowus platform, right?
That's
For 5 basis points, 8 basis points, 10 basis points.
So in short, we are able to invest, during two crashes, right? I crashed by during the 2020 COVID crash, and recently with this interest rate hike, inflation and interest rate hike, I crashed by again, right? That supercharged my Endowus account with OA and a bit of SRS. We have broke through 1 million as well, right? So clearly.
Amazing.
This, first of all, I gotta thank you for allowing us to do that, right? Because there's no other guys that allow this. How do you manage to do that?
Well, it's a lot of different things, but we started with the mission to do that, right? So we started with the mission to solve CPF because we want to solve every individual in Singapore to be able to secure a retirement where they can live a good quality of life, right? And so in order to do that, you have to invest your money, not just save. Because saving is just you get very low returns because you don't take risk. But if you take risk, over the long term, you will generate good returns. And we'll talk about this later about DCA versus lump
But
sum.
how do you manage to convince, why is it that you manage to convince CPF board to allow you all to invest OA into S&P fund?
Yeah.
And how come your competitors don't allow?
Well, the first thing is the technology we built is unique, right? So we
Okay.
built it for CPF, but no one else was willing to take that risk because we committed millions of our own money, built a whole team of tens of people over 2 years, a lot of time to build what is effectively the first digital platform for investing your CPF. And then along the way, we did two things. One is that we solved the cost problem. So because before we arrived, there was a lot of expensive mutual funds
Yeah.
and trusts, but no low cost passive S&P 500, for example. So
Yeah.
that's the first thing we did. And then the second thing that we did was we solved all the pipes. So the infrastructure and the pipes is very complicated. We brought in a separate investment administrator, all the technology to seamlessly create an account, pull the money from CPF, everything, UOBKN, where your money is. We never touch your money. UOBKN is the CPF investment administrator that we brought into the system so that we can enable this. It took 2 years, and the government and CPF did not give us, like in Hong Kong, actually, they do the same thing. They did a tender offer and then somebody won, PCCW won the mandate, and then they spent money and built it with the money government gave them.
I see.
This was a venture, right? This is why we spent our own money to build something, and the government then evaluated us and said, hey, the way you guys are doing it is the right way. You guys are doing it in a low-cost way. And we always say we did this for every CPF member to be empowered to do the right thing and invest in the right way, and the government agreed with us, and so they approved us. And since then, nobody else has even bothered to try. That's the problem, that the big banks, they have the money, the technology, but they just can't be bothered because it's such a small piece. And then the other robo-advisors, they just don't have the right talent or the technology. So we have an amazing team of 150 people whose sole purpose is building the right technology, the right solutions, the right funds and products, so that we can serve CPF members and also your personal savings, your private wealth, beyond public market, also private markets and alternatives. So we're trying to solve the problem of wealth for all Singaporeans, basically.
Wow.
Yeah.
Okay. So I think that's really amazing. First of all, I'm a huge beneficiary, clearly. Okay, having made quite the last check on my account was close to 30% profit. Okay, on my personal account, my wife is slightly less, 10% or so. But I think it's an amazing achievement. That I could never have done it, right? I could never have done it without Endowus.
But it works both ways. So you need Endowus because Endowus gives you access to the cheapest, like lowest cost, best products, funds at the lowest cost, and then we give you advice along the way so that you do the right thing. But you need somebody who will follow that advice and do the right thing, not like get emotional, buy, sell, trade the market. But really just continue to remain invested, and then whenever the market falls, you add to it and you keep adding and you add, and then you get to achieve these things. And I think the other guy, he's also an Endowus client, you said, right? Yeah. So he is doing the same thing with his OA and his SRS, which is very important for tax benefits.
Yeah.
Everybody should have an SA, Singaporean, PR, foreigner, everybody's allowed to have it.
SRS.
So people should, SRS, should be able to use that and take advantage of the tax savings to grow your wealth even faster.
Okay, so today it's very rare to be able to get a guru like him. I never use a guru on myself, okay? But he's clearly a guru, okay? If you agree, please give a like. I don't know why you're so meow with your likes, huh? I think it's the same. Why are you so stingy with your likes? How many likes do we have right now on your group? Okay?
Maybe they're too
It's a
busy.
Singapore behavior, it's a 165 behavior. Why nobody? It took me a lot of inhuman effort to invite him. I even got people from Abu Dhabi right now. Jennifer, good to see you.
Jumped up to 38.
Come on, guys.
something.
Okay. Basic courtesy. Okay, basic courtesy.
Thank
I'm
you.
gonna ask a few hard questions because we have got some controversy over this. Now, clearly, I've noticed this because a lot of people came to me. Right now, the whole market, of course, maybe last 1 week it softened a bit, but since we stepped in August, but it was going on a bull run, more or less a bull run, and everybody now, when the S&P 500 is on this bull run, everybody write into me and said, Mr. Lu, how do we invest? Mr. Lu, I want to start my DCA right now. Mr. Lu, I'm going to start investing right now. How do we do it, right? And I asked them basically a question: why didn't you invest when the market was down? Invest now, right? Then it evolves to a question of DCA versus crash buying. We're no longer talking about lump sum buying. DCA versus crash buying, right? And then I came up with this controversial theme that got a lot of people very upset. A lot. Okay, I'm going to ask you for your professional opinion. Dollar cost averaging versus crash buying. Okay, my thesis is dollar cost averaging doesn't work, okay, unless you automate it. The minute you humanly do it, physically have to do it yourself,
Yeah.
every quarter, every month, everywhere, it won't work because your emotions will come into play. And the fact that everybody want to rush it now to start DCA, that means they're doing on a high. Okay? So I tell them that when you crash, are you sure you're going to persist it, right? So I want to get your view on this. What do you think about this controversial
Cannot
topic?
hear well. People cannot hear well. Maybe it's the fan. Maybe we turn it down. Yeah.
People
Turn
can
it down.
is it
Yeah,
linked
it's
to
the fan.
Is the mic?
It's
linked?
this one, right? It's this mic. Yeah. Should be, that's
Hello, can you hear me?
I think the fan was just too strong. Yeah, fan it up. It might be better. Is that okay? Can people like if it sounds better? Yep. Thumbs up there. Yep. Okay. I think it's much better. I think
In the
it's fan.
event that y'all cannot get it, just make sure you get the link and the QR code. You can come over to my 1965 channel. It's the same as well.
Yeah.
The sound quality is much better. The one in Endowus uses sophisticated technology.
Okay. I think Wen Yang says we can hear well.
No, but that's on mine.
Yeah.
I think they have
No,
problem
it's
on
the
yours.
same thing. It's fine. I think it's okay now.
Okay.
Yeah. And then also Pat. Yeah. Who else? Everybody. Thank you for
Okay.
liking.
So again, right,
It's gone up a lot.
if you have sound quality on the Endowus channel,
Yeah.
just come over to the 1965, okay?
Yeah. Audio is loud and clear now. Okay.
Alright, good. Okay,
Perfect.
let's
All right,
go.
I think we sorted it out.
Let's go back to the question.
DCA.
DCA versus crash buying.
What is DCA first? For those that don't know, dollar cost averaging, and it's a form of like doing a monthly savings and investing. So you like regularly save every month and invest, or whenever the market falls, you invest. So different strategies, even in dollar cost averaging. But basically, the idea is that you don't put a lump sum, 100,000 all in one go. Like if you have 1 million, and as a result, after a few while, the market goes down and you lose money. So in order to avoid that, you actually spread that out across a long period of time. It makes most sense if you have income, regular income, like regular salary, and every month you have an income that's coming in, let's say $3,000, $10,000, and of that, you want to save 10%, $300, $1,000 every month, and you systematically invest every month because that's your income. If you have a lump sum money, then historically, if you do the maths, lump sum always beats DCA.
Really?
Yeah.
Oh, I didn't know that.
Over any extended period of time,
Okay.
it's lump sum beats DCA. The reason is because the equity market, especially S&P 500 or global MSCI ACWI or MSCI World, large like broad indexes, only would always be going up, right? Even last year we had 20% down, but it's up back again. 2020 we fell 30%, but we made it all back up and we're even higher.
Yeah.
And we're at a historic high every few years, and the market tends to be skewed, as we call it, skewed towards the upside. And that's because the market by nature is the best companies in the world. It's not your local coffee shop or even the Chasu fan place, which closed down during COVID. It's the biggest companies. It's companies that you spend all your money with, like Netflix and YouTube and
McDonald's.
whatever. McDonald's, Coke, and so those companies generate cash flow and earnings and grow in value, and therefore you're buying those companies by buying the global equity markets. And so naturally, of course, the winners will still go, and the losers will become smaller in the index, in the S&P 500 index, and the winners will be bigger, and therefore the index will always do better than a single company, which you cannot predict will do well or badly over time. So lump sum is taking advantage of the power of markets to continue to go up, right? And that compounds. So the power of compounding comes into play in growing your money. And the earlier you invest and the longer you invest, it's better. But why do people like DCA? And why is it so valuable?
And everybody preaches it.
Yeah, everybody preaches it.
Yeah.
It's because when we are trying to invest that $100,000, we want to time the market. We're human beings, and so we say, oh, the market's going on, I'm going to wait until it pulls back, but it keeps going up and you missed your chance.
Yeah.
Or the market's down and you say, I'm going to wait until it comes down, and then when it actually comes down, you think it's going to go down lower and you don't buy.
Sure.
So you don't take action when you need to,
Okay.
and then sometimes you panic and sell, like you lump sum, and then you have 100,000. It's a lot of money. It's up 20%, and you're like, oh my God, the market looks too frothy. I should sell. And so you take action when you shouldn't be. You should be invested in the market long term. And DCA helps you overcome this emotional problem. It's a behavioral problem that human beings have, of greed and fear. And so dollar cost averaging allows you to spread out your risk, spread out so that you have peace of mind. That's it. That's the only thing. It's not a scientific thing. It's an emotional, behavioral thing. And then the final point is what I said earlier about salaries and income. If you don't have any money saved up in your 20s, 30s, and your only money is, your $3,000 or dollars a month,
Sure.
so you only have $100, $200 invested every month,
Sure.
then you should invest every month instead of trying to save that up to 10,000. Because the earlier you invest, the better, even if it's a small amount.
Okay.
So that's why DCA matters, especially for younger people without any savings,
I see.
who are starting out, and those that have lump sum should go lump sum. Or spread those out if you're like emotionally very difficult to put everything. Even you did that last time, remember?
Yeah.
You should have bought everything, but and then you said, okay, half here and then next year. But it's still good because you invested. Which is great. Yeah.
So the main conclusion is that, for young people which you don't have a hell of dry powder, okay, your income comes in, apportion out regularly.
Yeah.
I will encourage automating it. You agree with me, right?
Yes,
Because if
absolutely.
you don't automate it, your human emotion is going to come into play.
Unless you're a very disciplined person and you can stick to that discipline and you can stick to the plan every month, I'm going to put the money in, you should just automate it in Endowus. And a lot of platforms these days allow you to just automate, and that's what you should do. You should just every month, the bank transfer the money in. And again, I say we do not ever touch your money. We built the platform so that it's most safe. With UOB Kay Hian, the largest broker in Singapore, who will create a trust brokerage account in your own name. You send your money from your bank account in your name to the UOB Kay Hian account, and then back again to your bank account. Named accounts only. Endowus never touches your money and keeps it safe. Even if Endowus disappears, absolutely safe. And UOB Kay Hian will continue to respect, the agreement that we have.
Okay.
And so you'll be able to do a regular savings for as long as you want throughout your life and get to millions, hopefully, with your CPF and SRS, and your cash as well.
So you remember, a lot of you ask this question, so what if Endowus goes down, right? Don't worry, as long as UOB Kay Hian is around, that's fine.
Not only that, maybe this is the time we should show this slide.
Yeah. Go ahead,
This slide
Okay.
on the 30, next slide.
Hey, my face is there.
Your face is there, yes.
Okay.
No, next one. There's a slide, no, 35 million. Yeah.
Okay.
So
Are
just
you will flip around, just show them?
No, there. They see. Oh, this
can't
group.
see,
Yeah. So this group, just this. I'm talking about this slide.
Okay,
so
we're
we
gonna
just
talk
made
about
a
it.
public announcement that we have raised 35 million US dollars. So 35 million US dollars is more than 47 million dollars Sing. So it's a lot of money, and it comes from existing investors. There's venture capital companies like Lightspeed, Process, which owns Naspers, which is the biggest shareholder of Tencent. And then we have Singtel, which is the biggest retail franchise in Singapore.
Yeah.
And then we have the Singapore government, Economic Development Board's global investment arm, EDBI,
Sure.
is an investor. And then we have UBS, the biggest private bank in the world. But this fundraise, all of them came in, but also we have MUFG, the biggest bank in Japan, which is the single largest shareholder of Morgan Stanley, the company I used to work with.
Oh, I didn't know that.
And Morgan Stanley is now the largest wealth manager in the world, right?
I
Together
see.
with UBS.
Okay.
UBS is the biggest private bank.
Okay.
Actually, they might have caught up with Credit Suisse merger.
Wow.
So we have the two biggest wealth managers, Morgan Stanley's parent, MUFG, and you have UBS, which took over Credit Suisse.
Sure.
Both as a shareholder. And then the last one is Citi. So Citibank came in and is a shareholder of Endowus. And Citi is a global wealth player, Citigold, Citi Private Bank. But also they have a really good advantage in technology. And Citi Ventures in the US is a very advanced investor in fintech, financial technology, and wealth tech, a lot of great companies that we can create synergies with. And then we have 4 of the largest Asian richest families also wanting to invest in Endowus. So 4 of them, we have a couple more existing. Some of the richest families in Singapore, Indonesia, Hong Kong, in the region, Malaysia, have come into this round to invest in Endowus because they believe in the team, the way we've built the business, the unique mode around the pension and CPF, and then in Hong Kong we're going to do MPF, and also and the expansion into alternatives as well and private markets. So Endowus has continued to grow every single quarter since we started the business. Every quarter we've grown. Second quarter again, historic high in terms of assets, in terms of revenues. But obviously we're a venture company. which means we have to heavily invest in talent and technology. So that's why we're still loss making.
Wow.
I wanted to touch on that.
Yeah. So I
Thank you.
Yeah.
Everybody.
So I think first of all, being able to raise $35 million in the current market is very, very tough. The current market right now is really tough to raise money. Some of y'all will know that I actually touch quite a lot of startups. And fundraising now is a nightmare. But you know what? I was gossiping with Singtel, and then they will say that, oh, everybody is rushing to pour money into Endowus, right? So I've never seen that before. So clearly, it's a vote of super strong confidence from all the best. Right? These are sharks, they call it Shark Tank sharks, right? They will put money only when they have confidence in this company, right? So I thought that was quite amazing. Is the valuation right now a secret?
Valuation is a secret.
Really?
So
wow. Okay.
So we've never had a down round, so this is not a down round.
Okay.
Again, if we continue to deliver, then the valuation of the company will go up. But it's something that the shareholders are not comfortable with. And this time we're actually doing it in the form of a convertible note. So
I see.
it's not there's a range of valuation outcomes that is going to be up.
Right.
Yeah,
anyway,
but it's not.
It's probably relevant
so it's not really relevant to most people today.
Correct.
But the point is that, we have some of the biggest global, local wealth managers, some of the biggest families, and some of the largest strategic partners, including Singapore's government, supporting us through EDBI.
EDBI.
Yeah,
Okay.
so, we feel very confident that we have enough strong shareholders who will continue to back us. This 35 million will last for quite a long time. But also we'll be investing very heavily to upgrade the technology, the experience, enter new markets.
Are you able to speed up the speed of the transaction?
Yeah, we have. Even account opening used to take 1 or 2 days. Now it was down to 5-10 minutes.
Okay.
Last month we changed it. It's less than 1 minute now. 50 seconds, your account is open.
Wow, that's amazing, right?
Yeah. So the holdup obviously was the offline piece, but Endowus has solved everything for everybody.
Wonderful.
So all these experiences, we have a new web 2.0, mobile app 2.0.
Sure.
And then a lot of content you might have seen. Ask your CIO, so you can go in and ask questions. I actually answer that myself. So it's not somebody writing it, it's me.
Okay.
So ask your CIO questions on the app, and a lot of great stuff and better experiences and faster processing times, etc.
Okay.
And we'll continue to improve. I mean, it's early days. We're only 3.5 years old, so since we launched CPF,
That's
so
amazing.
a lot to do. Yeah.
Okay.
But
Well
we've
done.
we've grown quite well with the support.
It's very impressive.
So very important clients like yourself and everybody else, but also our investors who have backed us.
We have got a lot of 1865 community are all your clients right now. Okay, so
Thank you.
So thanks for all your support. Another questions that come into my mind is everybody's asking right now. So Sam, how's the market going to do in the next 6 months or 12 months? What do you think right now? The market is like kind of like a sudden bull run and kind of taper off. We don't know where it's going to go. It's going to go up. It's going to go down. It's going to. What do you think right now? What's your professional opinion on this?
Yeah, so I think there's a lot of uncertainty still, but we've actually had a really good first half, right? First half markets did tremendously well and better than anybody would have expected, other than Lou and and partially me, because we have the fundamental belief in the power of markets to do what it does and has done for decades and centuries in the history of mankind, history of financial markets. And I'm a student of history, and it's really important to look back at what happened because oftentimes history repeats itself, right? And every time the market falls 20%, that's normally not a bad time to buy. It's actually normally a very good time to buy, and that's why Lou went in and did phenomenally well. But every time the market pulls back, and recently is amazing. If you think about it, 2018, the Fed started tightening the interest rate from 0. Post the global financial crisis for the first time really earnestly, and the market came down 20% globally. 2018, right? 2020, 2 years later, we had the COVID crisis. Within a month, the market fell 30%, right? And then recovered itself. So recovered in 18, recovered in 20, new high. And then 2022, market fell because of concerns about Fed interest rate hike, inflation, everything. Fell more than 20%. And now we're almost back to where we were. Right? And how many times in the history of financial markets have we had 20% plus corrections in 5 years? 2018, 2020, 2022. So only 2 years positive, 3 negative out of 5. It's never happened before.
I never thought of that.
So you actually, it's very rare for the markets to have these big corrections.
And
that's
huge
why,
opportunity.
and a huge opportunity
Huge
to buy.
opportunity.
Yes. And this is what Lou and I have been talking about because we believe in the power of markets. I explained what markets are. Great companies that are winners long term, generating great value fundamentally, generating earnings and cash flow, are the best business strategies and the things that we all use and spend our money on. That's the companies you're investing in. That's why the market does what it does. So at this point, I'm not going to say the market's going to go in a straight line. It never does. That's the volatility of markets. But whenever it pulls back meaningfully, you definitely need to be more bullish, not bearish. You need to be contrarian. When the markets go up, you don't sell your losers, you buy your winners, right? That's the other thing. You sell your losers and you don't sell your winners. So most people sell winners and the markets go longer and further than most people think. And people buy losers, but they normally continue to do badly. So the market understanding, people who've looked at history of markets a long time have always said that you should actually stay with your winners and sell your losers. That's why they have something called loss cut. So after 10%, 20%, you should actually sell it down and you should keep your winners.
Okay.
Because they're winning for a reason.
All right, good. Okay. So the next question I have, which everybody keep asking me, is that Sam, why don't Endowus have a Nasdaq fund, okay, or Nasdaq equivalent fund?
So one of the reasons is because every time, once in a while, something becomes very popular, right? And it's the flavor of the month, and people want it. And normally it's at the peak of the market, right? And so Kathy Wood's, what was that? The ARK fund. The most amount of money went in at the end of the cycle. And actually, most people lost money from it. And yes, it's coming back, but it's nowhere near what the market has done, right?
It's down by what, 80% or something?
Still down quite a lot.
Yeah.
And so Nasdaq is great, but we should not think of it as a core allocation. So you should always look at the investment that you make in global markets into a core allocation. So global, all country world index, MSCI, ACWI is a global index, so you're diversified. A dimensional fund, world equity is diversified. MSCI World is diversified across developed markets, and S&P 500 is diversified into the 500 biggest winners around the world, especially in the US. And US represents still a big chunk of the market. So you're diversified quite well enough. So you need to be diversified and have exposure to the overall market. And then on top of that, this is your need. And then you express your views with certain countries or sectors that you may do. And NASDAQ is one country, one sector, US technology. And so it's more volatile, so it's more risky than having an S&P 500 or in the market. So we do have certain funds that give you exposure to technology, give you exposure to US, but and we are working actually, just to let the fans of Mr. Lou know, that we are actually working on a NASDAQ index low-cost solution, but it's not out yet.
Okay.
And we will let you know. We are trying.
Okay.
Everything we do, we try to take into CPF, but it's a more difficult process.
Of course.
And so it takes a much longer. So the Amundi funds came out earlier, and then now we launched first the equity ones.
Sure.
Really excited to share that we launched the first, I don't know if you have a slide for that, but the first passive fixed income index fund. That one. Yeah. So we just launched for the first time a low-cost global fixed income passive index fund. Never existed in CPF before.
Okay.
From Amundi, and this is only 10 basis points, 0.1%
Wow.
fees.
Okay.
And now we're going to upgrade the CPF fixed income portfolio.
Sure.
And these guys yield 4-5%.
Really?
And generate long-term above 2.5%. So we feel that having a low-cost fixed income option, globally diversified, is really important. So we work.
Oh, this is good.
We work for almost more than a year.
What's the name of the fund?
It's the Amundi Global Aggregate 500.
My goodness.
Yeah, it's also 500.
Wow. Okay. So I think this is an interesting fund. I will be personally interested to look at that.
Sorry, I have to show you.
Okay. Yeah.
Space,
So
So for those of you on this side,
A lot of you ask me which fund, which
This is the
which
fund.
bond funds do I invest in. I can show you. This is a very interesting fund that I'll be interested in. Okay, so anyway, I'll get the link and I'll pin it up or something like that, right? Okay, very good. Let's now go into Q&A. Okay, I've asked general questions already. It's very interesting. So let's take advantage of Sam's presence right now. Let's go to a question, shall we? Okay, so let me do this question. Yeah, there's a lot of people who are now retirees, right? They're not like, in the 40s, not in the 30s. They ask me, now I'm 60 years old. I invest so little, what should I do right now? What can I do right now?
yeah, there's a lot. There's a lot. First of all, you have to understand that 60 is not an old age, right? Lou and I are the same age. We're above 50. Let's just
You are
say.
older than me.
No, am I?
I look younger nowadays.
Yes, you do. You look younger. Before I used to look younger, now you look younger than me. Better skin, better hair.
But I got all my treatment from his country, his homeland.
I need it too. My hair is like receding.
Okay, so jokes aside,
Jokes aside, but basically, 60 is not far off for us. But
Yeah.
let's say you're 60. How long do you have to live? The average in Singapore, this is statistics. When you're born, you live until 80 something.
Okay.
But if you live to 60,
Yeah.
then you're likely to live until 90 plus if you're a female, and almost 90 if you're a male. That's the data right now.
Okay.
Right?
Okay.
So you are likely to live another 30 years. And so 30 years is actually still a
Very
good long horizon to invest your money. Now at 60, if you have money saved up, then you might have to pull the money to start using it as income to spend and maintain your quality of life. So you have something that younger guys don't have, which is a need. You don't have income, but maybe you do. 60, you're still working probably, and you have an income. Then you should be saving and investing that wisely. And then the savings that you have should be invested for the appropriate risk that you need to take. So the appropriate risk can be something, as you said, as I showed you, CPF, especially your CPF money. SA is locked up, okay? We understand that. OA frees up after 55. You should think of it as a high interest deposit account, and you can take the money out anytime. So it's like a deposit, but you cannot put it back in. So you need to understand that this money is probably the last pot of money you want to use. Like you use your cash, SRS, everything else, and then CPF OA is the last pot of money you touch.
Listen carefully, okay? This is golden rule.
Yeah.
You touch your CPF, OA, or even SA
Even
last.
Last.
Okay? Yeah, don't think it. Once you take out, you cannot put it in. Yeah.
And you have a lot of benefits from OA because you guaranteed 2.5%, right? So you can use that and keep it. You can invest your money with Endowus. And you can invest in everything, right? Basically, now you have a low-cost fixed income, so you don't have to take equity risk. If you're really conservative and you want to preserve capital, and you want to generate maybe 4 or 5% a year, long-term, maybe in a fixed income portfolio of some kind, like the Endowus CPF fixed income portfolio, 100%. Or if you think that, with 30-year horizon, you can take a little bit of risk and have 20% equities or 30% or 40%, then you can do that and have a balanced portfolio with more fixed income and less equities, but you can take some equity risk. And with that balanced portfolio, you're able to generate maybe 6-7%. And over 30 years, that will compound to thousands of percentages of returns, actually.
Thousands
of percentages of return. So you multiply your money over 30 years, which is why you need to invest. You can take less risk, you can buy fixed income, but you still need to invest it and get more than 2.5 because 2.5% just is not enough and it's below inflation. Inflation in Singapore has been 4 to 6% last couple of years. For the last 5 years, CPFOA 2.5% has not beaten inflation, and so we need to take advantage. And I don't know what your political spectrum is and who you're going to vote for presidential election, but Tharman came out and a lot of government officials who are finance experts, who are, who care for the individual Singaporean have come out and said, we need to do more. We need to do more with our CPF. We need to take more like control over our investments, our finances, and start investing more, because that's the only way Singaporeans can grow their wealth in a meaningful way over a long period of time.
Okay.
Yeah.
Two quick questions. Number one is, how can a foreigner invest through Endowus?
Yeah, so Endowus, I know a lot of people know us for CPF, and we're the first to digitize CPF investing. We're really the only ones. There's only one other small player, but we are by far the largest and the first to really have proper technology to give you a good experience. And we have these exclusive funds that nobody else has, right? That is low cost, passive index funds, S&P 500, etc. So wonderful. And so you should use your CPF on Endowus, but Endowus does so much more. We have SRS, we have, cash savings. So your personal savings, your private wealth, maybe the private wealth slide, but the personal savings, private wealth, and your SRS and your CPF can all be managed seamlessly in terms of the multiple funding sources. So all your money is one of those pots, right? And then the previous one, previous slide, yeah. And then we have private wealth services for those that want more sophisticated solutions. The next slide has private and private and alternative markets as well. And what I'm showing to everybody is this slide basically, which is the Endowus Private Wealth service that we have launched for those who are accredited investors, and they have access to private markets and alternatives, which are other tools and asset classes that we can take advantage of if you want to grow your wealth in a more meaningful way as well. So all these solutions are available. So as a foreigner, the only piece you cannot do is CPF. You can do everything else. You can do SRS. Every foreigner should be doing SRS because massive tax advantages. Singaporeans can do less SRS because you have CPF, 37,000,
Sure.
12, 13,000 in SRS,
Sure.
but foreigners can do 36,000 SRS, and all your cash, personal wealth, private wealth can be invested as well on Endowus.
Very good. Yeah. The next question is on the fixed income portfolio that you just said just now, the 500
Global
something.
aggregate, yeah.
We can come up with more catchy name, easier to.
But that's the index. That's the index name. Yeah.
Oh, that's the index
fixed
name.
income Bloomberg Global Ag Index is the most broad. It's like S&P 500. It's like MSCI ACWI. The index.
Does it give a yield?
Yeah. So
How
the
much is
yield
the
of the
yield?
market, I can't remember the exactly. I think it was 4% the last time I looked.
US dollar?
Yeah.
US.
Yield. Yield.
US.
This is Sing dollar.
Sing dollar,
Yeah.
4%.
This is CPF.
Wow, that's good.
Yeah, CPF.
That's very good. Yeah.
Yeah.
So 4% a year.
But the reason you buy fixed income is, we have this inverse correlation, right? So when interest rates go up, you lose money, and when interest rates start coming down, you make money. So the capital gain on top of the yield that you get is what allows fixed income to outperform.
I'm hoping for the interest rate to go down, and it will go down one day, right?
Yeah, it may not
and
be
the
this
day
year,
when it
but-
go down, the bonds should, in theory, have a capital gain, right?
Yeah, absolutely. That's why investing in fixed income is important, and it's so Sam at Cecil Street.
Okay.
Thank you. I lost my track of thought. She called me handsome, so I was like, oh.
Who's that?
So
Okay. Don't get distracted by ladies.
yeah, Lou's jealous, so he's trying to avoid. Yeah. Thank you, Y.
Yeah.
Thank you, Y.
Yeah.
But basically, fixed income is a great opportunity right now because interest rates are peaking. So Federal Reserve in the US is, maybe one more hike, 25 basis points, 0.25, 0.5, who cares? We're already there. The market already moves ahead of that.
Okay.
And when the market starts thinking that the economy is actually slowing, inflation is down, then the market will see market interest rates go down. Even if the Fed doesn't cut, if the market interest rate goes down, then bonds will outperform and start generating returns, positive returns.
I'm waiting for the day to come.
So that's why this is so timely. The Global Ag Index, Bloomberg Index being included into CPF, and you can buy for 0.1% is phenomenal, right? Because you can have that.
Okay. Let's take another questions from the group. This is a very important.
Yeah.
I have a experience on this. Time to switch funds.
Switch funds.
Time taken to switch funds within Endowus. It's very long, Can we do something about that?
So
It
we
takes
re-
3 to
we-
5 days sometimes.
No,
Yeah.
no, no. So there's two things. One is
Right.
the actual time it takes,
Sure.
and then the second one is the perception that it
Okay.
takes a long time. So
Okay.
we don't want to mislead clients. So we can say that, look, when you place an order and you place it in the morning, then the order is executed that day at night, overnight, right? And we only do once a day NAV. So there's no intraday stuff because we don't want people to trade. Because we're really building wealth over the long term. We're investing our CPF for decades.
Sure.
You shouldn't be buying and selling every
Of
day,
course,
right?
of course.
So that's the first thing. You shouldn't be trading anyway
Sure.
or trying to time the market. But even if you are just regularly investing every month or whenever you need to,
Sure.
you put the order in the morning. It's traded on that day, but it just takes time for the funds to settle.
Okay.
So it's not a stock. It's not an ETF,
Okay.
which has a live price and you can settle and you set it.
Sure.
The NAV would be 1 day in arrears. So it's
What's NAV?
NAV is the net asset value, the
Sure.
true value of the fund. So
Okay.
ETFs trade in the market, so it has a price.
Sure.
Which means that the fund, the value of the fund, which is NAV, net asset value,
Sure.
and the price should be the same.
Yeah.
And in our case, it is the same because every day we only do one price, one NAV,
Okay.
and it's the same. There's no fluctuation.
Sure.
That's the true value of the portfolio at the end of the day.
Okay.
But an ETF, because it's traded in the market and you're buying and selling, it moves away from the NAV. It has a premium or a discount. So it's an additional cost when you try to buy. And when you buy, you put in an order and there's an offer and a bid. So there's a bid-ask spread is what they call it. So bid-ask spread, premium discount to the NAV. And so two layers of additional cost that a lot of people don't understand exist in ETFs. And then on top of that, because you're a Singapore dollar investor, you're buying ETFs in US dollars here in SGX or US or Europe. You have to do an FX trade, which is even more costly. And then especially UCITS is great, local ETFs are okay, but in the US, you have an additional layer, which is withholding tax
Sure.
and estate tax. So
Sure.
there's multiple layers of fees, whereas we just buy the fund, NAV, once a day, fixed price, no premium discount, no bid-ask spread, no FX cost, all absorbed in the fund, and you just do it at that price. And therefore, you hit that price on the same day, but it takes a day or two to settle. And then it takes another day for the money to come in. But your trade has happened already.
So that
So you need to
price
understand
is fixed.
that price is fixed on that day.
Okay.
And you traded that day. Normally, it takes a day to settle and the money to come in. So it's maybe a day or two delayed.
Okay.
But even that has improved since, when we first started, which took 4 or 5 days
I see.
sometimes.
Okay.
And then it depends also on the fund manager. So
Okay.
we may want to do it quickly,
Sure.
but the fund manager has to go through their process. And if they're not digital
Sure.
and they're not like automated or technology
Sure.
enabled, then they're going to take longer. So they come back to us late, then we are delayed as well. So some of it is us, but some of it is stuff that's in KN's hands because they take time, and then the fund manager. But the most important thing is when you sell, when you buy, the trade is done. So your price will be fixed
Within a day.
within a day.
I see. Okay. What's your view? A few other questions, quite important. What's your view on China market right now?
China, let's start with the economy, because the economy is suffering quite badly. I was on Bloomberg TV last week explaining a lot about China because the trade numbers came out and the CPI number, PPI numbers are coming
Deflation.
out. Deflation, yeah, and for good reason, because if you look at the price of CPI, it's actually very shallow. It went up a little bit and now it came down, it's negative. PPI, which is commodities, raw materials, input cost, obviously
Producer
more
price
volatile.
index.
Producer price index jumped much higher and then came back down, and it's sharply negative now, year on year. Sharply down,
Okay.
negative, like -7%, is going to minus 10%.
Okay.
But so as a result, what brought consumer price up in China was actually not demand, but it was cost push.
Okay.
So there's two types of inflation. One is demand pull, meaning there's a lot of demand for something and
Sure.
not enough supply, and therefore price goes up.
Sure.
Just. Or it's cost push, that demand is weak or whatever, it's the same, but because the input cost has gone up so much, the price is pushed up. And a lot of it was demand, not demand pull, it was cost push. So if cost goes down again, inflation goes down, and that's what happened in China and happening in the US as well. So deflation is the norm in China, disinflation and deflation. and that comes from a fundamental weakness in demand. And the demand, a lot of people think China is exports, trade, but no, China's domestic demand is important, and consumer especially
And it's
is
bad
the
now.
most important. And COVID, 2 years of lockdown, sentiment, politics, ideology, a lot of things, and news flow, Ukraine, I don't know, so many, Taiwan, there's so many things that have happened that has depressed the consumer sentiment, and as a result, demand from especially consumers is very weak. On top of that, you have manufacturing weakness. A lot of manufacturing is leaving China because China is becoming expensive as a manufacturing place. Labor cost has risen. People don't work like they used to, so productivity is not gaining. And then also investments, and a lot of US companies and other companies are pulling out. And so you're actually seeing a lot of move away from China to Vietnam or Sri Lanka or back to the US even. US production manufacturing has grown tremendously. So manufacturing is leaving China, which means that industrial production weakens, which means that people lose jobs or the salaries don't go up as fast. When there was everyone was building factories and hiring people, cost goes up, but it's come down. And so therefore it's a very difficult situation from a macro perspective. And they have a lot of debt, especially in real estate, which is doing very badly. And then you also have local governments, which are kind of related, a lot of debt. And debt, economic research shows us that if you're very heavily indebted, the extra dollar of debt that you put in to grow is less effective. So whereas before $1 can buy you $1 of growth, you put in $1 now, you only get 10 cents of growth. So the momentum of the market, the velocity of money is declining when you have too much debt. And so you need to restructure, reform, make the economy more efficient, but what did they do? They busted all the tech companies. So entrepreneurship, technology is not doing well. A lot of money is leaving China. People want to leave China. So there's a lot of uncertainty and doubt and risk associated with China macro. And that obviously weighs on earnings and the market as well. So unless we have positive momentum, it's difficult to see from a fundamental perspective. But the only thing China has is that sentiment sometimes turns very quickly, as it did recently when government policy changes. And China, more than any other market, is driven by government policy. So government policy improves, market starts reacting. But is it sustainable? Not until we have fundamental reforms for us to have a sustained bull market. So it's a trade at best. And maybe you can have some long-term investments, but I would diversify away.
So do you think that China will go into the 10 years, like this 10, 20, 30 years of like Japan, kind of a dead market? There's some similarity, right? The property market has burst, and then there's a lot of overvaluations have come down, heavy debts and things like that. There's some similarity with the Japanese in the 80s.
Japanese in the 90s, 1890s, and then Korea after that, Taiwan. A lot of countries
go through that.
Asian financial crisis was a result of all of that in Southeast Asia. So a bit of a bubble, and then especially in the real estate market, and then coming off because a lot of it was driven by debt and cheap debt. And so that's a problem. Having said that, we haven't had the blow up of Japan. We haven't had the bubble, I suppose, as much as Japan. And the bust like Japan. And China is still growing and it's still earlier in its development, so there's still hope. But you do need reform, and you need to reinvigorate the entrepreneurial spirit. You need to encourage the tech entrepreneurs.
It's not going to change overnight.
Innovation, and it's not going to change because it looks like President Xi Jinping is much more ideologically driven, common prosperity, restoring communist kind of ideals, and I don't think it's going to change overnight.
Are you personally invest in China?
Only in my global portfolio, not directly.
All right.
No direct exposure.
Mr. Lu has zero in China.
Me too. Zero direct investments.
Zero.
Yeah.
Okay. And what's your view right now on Bitcoin? Crypto.
It's a very volatile investment, I would say. I wouldn't even define it as an asset class or a financial instrument, but it is a financial instrument, I guess, if you're investing in it to gain money. but there's no fundamental still. So, it's just demand and supply. When there's a lot of demand because people get excited, then it goes up, and people get worried, then it goes down. But the beauty of Bitcoin in the old days and crypto early in the early 2000s, mid 2010s, was that it didn't correlate with financial markets. It didn't move with financial markets. Sometimes markets go down and it would still just rocket ship, right?
But
now it moves with markets. It goes down with the market. It goes up with the market. It's just a higher beta, as they say, higher, more volatile.
Yeah.
Like CPI, PPI, it just moves higher. Bitcoin just moves more than equity markets.
That kind of defeats the purpose, right?
Defeats the whole purpose of diversification. But if you want huge leverage and you're bullish and markets are going up, then yeah, maybe you can play it a little bit. But I don't invest any Bitcoin or crypto. Do you?
Zero.
So you can still make money and have a good night's sleep and not stress about stuff by having global market exposure rather than crypto exposure.
Okay. So right now, for anybody in our channels that haven't started investing through Endowus, or even haven't started investing much into equities or bonds and things like that, what's your best advice for these people? In my audience, the average age is between 40 to 60.
Yeah.
Okay. What's the best advice for them?
Yeah, I mean, first of all, it doesn't matter your age, doesn't matter how much money you have. You need to get started if you haven't invested. So it could be a small amount, it could be $1 cost averaging. We've told you it's not maybe the best, but at least it's starting. Yeah. Okay. So start with DCA if you're uncomfortable, if you're risk averse. Maybe not equities immediately, or a small portion of equities, 20%, and then more in fixed income. But gradually over time, it really depends on your investment horizon. If you're young, you should have a decent equity exposure. And this year is a prime example. No one knows when to buy. No one knows when the market will bottom. Industry saying, picking bottoms is a dirty business. Right? So trying to pick the bottom of the market is not only a difficult, impossible, but dirty business. And so you should continue to invest, stay invested, because unless you're investing regularly on the way up and you're investing regularly on the way down and then investing regularly on the way back up, you're not investing at the bottom. No one can pick that bottom, right? But if you invest on the way up, you're investing on the way down, you're investing and picking the bottom and then continue to invest. So that's why it's important to continue to invest, because you will then have exposure at the bottom, capture the upside of the market. And we know that, I think this is a chart that maybe we can share later, but people who miss, like some of the biggest rebounds in markets comes at the bottom. And those people who miss most of the initial rebound lose out a lot on the long-term returns. So you need to be invested, and the only way to be invested at the bottom is to be invested throughout the cycle, because the cycle will do this, but it will always go up.
So this big topic called property, right? Property has been having this bull run, right? Right now, everybody believes that the Singapore property is invincible. Invincible, right? We now have HDB. It used to be just breaking 1 million. Now they're breaking 1.4, 1.5 million.
Gangbusters.
And it's old HDB, and property prices are shooting up. Korean has fallen, US has fallen, Japan, I don't know about Japan, UK has fallen. Everyone has fallen except Singapore. Everybody thinks that it's like invincible, right? So why invest in stocks and bonds and all this where you could, through leverage, phenomenal returns in Singapore property, right? What's your view on this?
Real estate is like any other asset class. It's driven by demand and supply. Fundamentally, price is always driven by demand and supply. So COVID has restricted supply for pretty much every country around the world, but especially countries like China, US, Singapore, etc. But China was already in massive oversupply. Singapore was in a slight undersupply situation, and we expected new supply to come in, but it didn't for 2 years. And so now we're delayed, and as a result, prices have gone up, and that's been exacerbated by the stronger demand we've had, because we've had liquidity. So local people are buying. You have foreigners, expats relocating from Hong Kong, Korea, elsewhere into Singapore. So you have expat demand. You have the massive Chinese demand, especially for the high-end stuff. but across the board, Chinese are more arriving. And I was speaking to another friend in China, and his view is that people underestimate how much more we have to go. More Chinese will eventually come to Singapore, not less.
Really?
Yeah. I was thinking it's peaked out, COVID's over, reopened, everyone's going back, but they're keeping that house.
Okay.
And not only that, there's more coming because it's opening up.
Okay.
Those that couldn't get out are going to start coming in. So long term, there are some demand, structural demand, but because the price has gone up so much, I know a lot of expats leaving Singapore and a lot of friends, moving to maybe Thailand. I had a neighbor, Japanese neighbor, they're going to Thailand because Singapore's just getting too expensive. So there's a lot of anecdotal evidence that people are also getting priced out. And then you look at the HDBs, it's just a trade, it feels like, because people are playing on the sentiment. The quality of the property may not justify it. And so, I can understand everything else, but maybe we're closer to the peak. But the bottom line is, even at this peak, if you calculate the annual return, net of cost of property, it's actually behind equities. And that's the fact, right? You have to look at the statistics of owning a property versus owning an equity in S&P 500 or global markets, MSCI. You buy MSCI over a long period of time, it beats every property exposure except private real estate in certain segments, in certain markets, but generally equities are soundly beaten, real estate, fixed income, bank deposits for sure, T-bills, and every other asset class.
Can we have a debate on this? Okay, a lot of people, you might want to record this. A lot of people thinks that it's not fair to compare equities, unleveraged, with property, which generally involves leverage, right? So it is true if it's unleveraged versus unleveraged, property versus equities will be. But most people will leverage the property and unleverage the equities. So in that sense, your last statement may not be fair. So what's your view on this?
Okay, so first of all, I am not against property or allocation to real estate. So I believe that asset allocation is really important. You need to have a holistic approach to your portfolio. I just don't like people to be blindly just investing in real estate and that's all I'm going to invest in because that's all I know.
Which is many Singaporeans.
Or the barbell strategy, which is real estate and FD and doing nothing else. I mean, I think you should be diversified because you don't know what will happen in the future. You never know, right? So that's why it's from a perception, approach of asset allocation. And we know that long-term asset allocation derives a lot of long-term returns. So as Jackie highlighted, I think real estate really depends on your location, which country you're in, which region you're in, what type of property you're buying. Is it a GCB or is it a condo or is it an HDB? Different cycles will have different drivers.
What price do you buy?
Freehold, 99 year. Never buy 99 year in Singapore. Hong Kong, you can buy 99 year. I learned that lesson the hard way. But generally, I think real estate is important because we need to live somewhere. It's our home. So there's an emotional reason, there's an absolute practical reason that we should own a home. And rather than rent or do other things, owning a home with a mortgage with leverage so that we can buy the home that we want and upgrading it later is fine. But having multiple homes and just trying to generate yield on it is not the best way to build wealth over the long term, especially at this point in the cycle. I think 10 years ago, 20 years ago, maybe more stronger argument, but at this point in the cycle, it's a much weaker argument. And Jackie is pointing out that stocks and companies also have debt, so there is leverage. Not as much leverage as we used to have, Jackie, in companies. A lot of companies are also net cash, so they have more cash than debt. So much less leverage in the system generally in equities, and that's why it's more healthy. And the companies are actually churning out much more cash flow. And this interest rate environment actually helps you because you get good yield on your cash. So those companies are actually generating, and part of the reason why earnings has been holding up better than expected.
Okay, there's a question. MSCI World Index versus S&P 500. Now that day when we had a session with Mr. Ng Kok Song, Mr. Ng Kok Song says that people ask him whether S&P good or not, right? So his view is S&P 500 is probably very US focused. What he would do is, he would go global, and even when we take S&P 500, 70% would be US anyway.
Yeah.
Okay. What's your view?
This is
MSCI
fair.
World Index
Yeah.
versus S&P 500. Which one would you pick?
Okay, so MSCI World is actually a developed market index. So US represents, 90%, I think.
Okay.
80 something percent, 88%.
Sure.
Of the index, if I remember correctly. It might be lower or higher, but doesn't matter. US is so big. So the DM, the rest is Europe and Japan. It must be smaller than 80, 60% because you have Europe and then you have Japan and then you have developed Asia, some other Canada, etc., which is not technically US. So you have MSCI World, which is, but the companies in S&P 500, as you said, is US companies, but it includes Netflix, Amazon, Yahoo.
They're global anyway.
They're global anyway, and
Yeah.
their income comes from multiple companies, including China. So you do have exposure in China through S&P 500, and decreasing probably.
Yeah.
But so S&P 500 is, I think, diversified. MSCI World is more diversified, and then MSCI All Country World Index, which is DM and EM, is even more diversified. But what's interesting with MSCI World is that recently, for a while, Europe and Japan actually started outperforming US for a while, and then the US came very strongly back. So in an environment where US is actually underperforming, Europe and Japan does better. Overall, there could be a scenario where MSCI World does better for a little while. But generally, I think US is a very strong economy with very strong companies, global companies. So I think we should definitely, we're okay with S&P 500, MSCI World, or MSCI All Country World Index. Whatever is the lowest cost way to gain exposure. And also, you should just stick to that investment on a regular basis.
Okay, so maybe I'll touch on last few questions. Okay, so right now, okay, if you step back right now, if you look at the overall world economy, so the war in Ukraine and Russia, we don't know where to go. It's nobody's winning, and nobody's winning is probably going to go on for a long time.
Seems that way, unfortunately.
The US inflation is finally cooling off. Eventually, it will come down. It should return to normal. Interest rate that's very high right now, will go down. Okay, China is probably going to be in a bad shape for a little while, and so on, right? So and global inflation is probably also following US will come down as well. In the light of all these things, how should we deploy? How should we be deploying our cash and our CPF? To take advantage of what is to come, right? Or do we play defensive, offensive, aggressive? Or what would you advise?
So I like to always say that how we invest depends on not what happens in the future, but what is our need for the future. So it always starts with me, not with what markets are doing, what economies are doing, what's happening in the war. It should always start with me and how much money I have, how much I can save, and how much am I willing to invest? What is the risk I'm going to take? And what is it for? So the investment objective is not, I'm going to generate 20% return or I'm going to maximize return. Your investment objective is why you're saving for the future. And the future is your retirement, right? Your needs. Because you need to have a certain income in your retirement. As we said, you're at 60, you're going to live another 30 years. That's a long time. And if you run out of money, you're screwed, basically, right? So
I can't be working at 90.
Yeah, and people are gonna have to work longer if they don't have any income, right?
Sure.
So you need to save now, early, to make that. And even if you're 60, you still have time to continue to build wealth and sustain that. And so it's important for you to really start with yourself and understand what you're investing for: house, retirement, car, children's college fund, whatever it is, and very specific. Be specific with your investments, and then for that goal, what returns do I need to generate? How much do I need to save now? So if it's $300 a month, you can calculate on the Endowus calculator really easily on the platform. 300 recurring investment every month, and it will generate a certain return. And I'm gonna take a risk of this much to generate the outcome I need by 10 years, 30 years, 50 years, whatever it is. And then you work backwards, and that will help you crystallize how much you need to save, how much you need to take risk. Because risk is what's going to determine the return. It's not the other way around. You can't target return, you target the risk you take so that you can generate the return. And that risk is dependent on what assets you buy, because the risk is inherent in equities. It's certain risk inherent in fixed income, certain risk inherent in deposits and money market funds, certain risk in fixed income, private equity. So you need to asset allocate according to the risk, and then that will give you a portfolio that will generate, let's say, 6% targeted return. And if I save $300 a month for the next 10 years, this is what I'm gonna get, and that's gonna achieve my goal of sending the kids to college.
Okay, very good. Okay, I think we should call it an end. It's near dinner time for everybody. Yeah. So just to remind everybody, there's a QR code. There's a QR code. Are we able to flash a QR code?
Yes.
Okay. Everybody, please scan this QR code, please. This QR code will entitle you to $100 off when you open up a Endowus account. Okay. You may have to push it a little bit further. Yeah. Okay. QR code. In case you miss the QR code, I'll try to put it. Xing, can you put it on the Telegram group? Yeah. The 165 Telegram group will have this as well. This is $100 off. For some of you, $100 not a very big deal, but to me, $100 is very big deal. Okay. Yes. So
and it's to celebrate our fundraise. And $100 is a lot of money for us, because you actually have to, invest quite a lot of money to pay this fee, because Endowus fees are so low. So,
very important. Okay, very important.
Low cost, low fees. Very important in generating returns, because cost is your biggest enemy when it comes to investing.
Very good. Okay. So first, last and not the least, we'd like to congratulate Sam and his team for a very successful fundraise. It's a affirmation from the industry that this is a great company. I've always known of them as a great company, even before they had their first customer. I was there all the way from the start, remember?
That's right.
Yeah. So
and Lou helped us a lot, because Lou is, a lot of people don't know, he's actually a marketing guru. So he's actually a lot of marketing expertise. He runs sessions really well. So as a friend, I invited Lou to our team when we were on Neil Road, the shop house, 3rd floor. We had to go up many stairs.
Yeah.
And we asked him to come and do a session with the leadership at the time to kind of come up with ideas of how we should position, what is the kind of the language we need to use. So Lou gave us very important, valuable advice to set us up and for success. So we've had a long time to really get to know each other. Lou's been on this journey with us throughout. And should we talk about because Lou has asked us in the past, should he invest in Endowus? Should he invest in Endowus? And it was very difficult for us to do so, because the company actually started as a bootstrap company. Bootstrap means that we do our shoelaces on ourselves, which means that we didn't get external investors investing in Endowus to fund it like a lot of venture companies do. We put our own money into the business. Me, Greg, our co-founders, but every single employee, Shengxi and JP, everybody put money into the business to grow it. And that's how we feel we grow together as a company. And so we have an opportunity for some of our partners and clients to participate, not in this round, this is already done, but in a secondary round. So
I'll be no, it's already signed.
Signed. Okay, today.
Yeah, today.
Okay.
Today. Yeah.
We're celebrating a lot of things today, but Lou is becoming a shareholder of Endowus.
All right, cool. So
not yet, but soon,
very
soon.
The paper has just been signed. Okay, but all the while I've got zero interest.
Up to now, nothing. Okay. We've always said that, we've been honest, and even this time we talked about it.
Yeah.
And it's not a huge investment by any means, looking at how much money Lou has, but it's still meaningful.
It's an affirmation
for me,
of support.
Yeah, as a friend, I think it's really valuable, and thank you, Lou, for the support.
Thanks for
belief in us. Yeah.
I've always I've benefited from you guys, right? So have you guys who have made money with Endowus. Congratulations to you guys. Okay. So anyway. Thanks for this. Thanks for coming and give us this very nice coaching for all of us. your insights today. I also benefited tremendously from it. And for you guys who wants to sign up, just go ahead, okay? And thank you all for joining us, right?
Yeah. Thank you, everybody. Wonderful time, and thank you, Lou, for
Thanks.
doing this again. Yeah.
Okay.
Thank you so much.
Good. Okay.
All right.
So have a good weekend, and I'll
Have a
see
good-
you. I'll see you again. Okay. All right. Bye
Have a
bye.
good evening.
Bye bye.
Bye. Have a
Bye
good
everybody.
weekend.
Bye bye. Bye bye. Okay. This is where we do this and bye bye. Okay. All right. Then we did.
Yeah.